Crypto charts can look like a complete mystery. Lines, candles, and numbers everywhere. But what if I told you you could decode all of this in under 20 minutes and feel confident in making your first trade? In this video, I'll break down everything you need to know about reading crypto charts, even if you're just starting from scratch. If you're new to crypto and want to learn everything you need to know in one place, be sure to hit the like and subscribe button below so you can be notified every time I drop a new video. So if you're ready, let's start by understanding why reading crypto charts is such a big deal and how they can transform your trading. Charts let you see price movements and trends, which is key to making informed trading decisions. When you're exploring a new city, a map helps you understand where you are and helps you decide where to go next. Without it, you'd be wandering around aimlessly, not knowing where to go next. Similarly, in trading, a chart acts as your map in the financial markets. It shows you where you are with the current price or the trend. It shows you where you've been with historical price movements. And it shows us potential routes ahead, which for us in trading would be patterns or signals that may suggest future price movements. Just like a good map reveals shortcuts or areas to avoid, a well-read chart can highlight opportunities or risk, helping you navigate the market with more confidence and clarity. Let's be honest, would you drive in an unknown city without a map? Probably not. Just like you wouldn't want to place a trade without understanding the chart. Let's look at different types of charts available and find out which one works best for you. The three most common types of charts are line charts, bar charts, and candlestick charts. A line chart is good for seeing the overall trend but has limited detail. It is a single line connecting the closing prices of an asset over time, making it easy to quickly identify uptrends, downtrends or stable trends, patterns or fluctuations in the data. Traders may often use line charts to compare different data sets. For example, you could compare the price movements of Bitcoin against the US dollar simply by coming to the plus sign where it says compare or add symbol, selecting the asset you wish to compare against Bitcoin, select new price scale. The asset you have just added will show up in a new color, so the US dollar is the pink line and we can adjust that on the right hand side where the price scale is, and the gray line is BTC. By looking at them together we can see whether the asset moves in the same direction or at the same pace, or whether they move differently. A bar chart gives you vertical bars where each bar represents price movement within a specific time period. Because I am on the daily time frame, each one of these bars represent 1 day's worth of price action, but if I was to change the time frame that I am on, so let's just go to the 4 hour, then each one of these bars represents 4 hours worth of price action. The top of the bar represents the highest point that price reached within the 15-minute time period. The bottom of the bar represents the lowest point price reached in the 15-minute time period. The small tick to the left of the bar shows you the opening price, and the small tick to the right of the bar shows you the closing price. A bar chart gives traders more detailed information than a line chart, making it easier to see the price range and momentum within each time period. A candlestick chart is similar to a bar chart, but displayed as candlesticks with wicks and bodies. The coloured part of the candle is what we call the body. If the candle is green, then the bottom of the body represents the opening price of the candle, and the top of the body represents the closing price of the candle. If the body is red, then the open price of the candle is the top of the body, and the bottom of the body is the close price of this particular candle. The sticks that you see poking out of the body of the candle are what we call wicks, and these show us where price have been. They show us the highest and lowest point this particular asset has moved within a specific time period. So if this was a 15-minute candle, then it shows us that price managed to get all the way to 119,843 before the sellers came back in and pushed price down. If the body of the candle is green, then this tells us that this candle closed higher than it opened, giving us a bullish candle. If the body of the candle is red, it means price closed lower than it opened trend, giving us a bearish candle. The candlestick chart is the most popular chart for crypto traders because it shows detailed price action and patterns that can signal future price movement. So today we'll focus on candlestick charts, as this is what most pro traders use. So what exactly do candlesticks tell us? Every candlestick tells a story. They tell us a story between the bulls and the bears, or buyers and sellers. With a simple Google search, you can find all of your bullish and bearish candlestick patterns, but for today, I'm going to focus on the ones that we in TTC use. Bearish candlestick patterns show us stronger selling pressure than buying pressure. So let's start with dissecting this evening star. Here we can see the bulls, or the buyers, are pushing price up and they start having a wee bull party. Great. The next candle opens and it's as if the bulls or the buyers' invitations got lost in the mail because price is just struggling to push any higher. The next candle opens and then the sellers step in to push price down and crash the bulls party. The party closes, then gives us this bearish candlestick pattern, which all three of these candles together are what we call an evening star. The same logic applies to the bearish railroad track, so these two candles together, and the bearish engulfing. So we have buyers attempting to push price up before the sellers step in to push it back down. These bearish candlestick patterns help us as traders to spot when selling pressure might lead to reversals or continued price drops. In a downtrend, bearish patterns can signal continuation of the trend, and in an uptrend, bearish candles can signal potential reversal incoming. But you don't want to find bearish candles just hanging out in the middle of nowhere. You want to find bearish candles near major resistance areas to signal a reversal may be incoming, or if price was already in a downtrend, you might use them with other indicators like EMAs, RSI, or volume. Now, my personal favorite bearish candlestick pattern is an inverted hammer. Usually we like to find inverted hammers with small bodies and large wicks to the upside. Within this 15-minute candle, we can clearly identify that buyers tried to push price higher before it snapped back down, showing us the sellers coming in. The candle then closed as the bearish inverted hammer. But that isn't why it is my favorite bearish candlestick pattern. The reason is because I can clearly identify what we in TTC call trapped traders. So when you first start out learning about candlesticks, you get told everything I've just told you. Buyers come in, push price up, sellers come in, push price down. It's a battle between buyers and sellers, and that is entirely correct, but there's more to the story than what you've been told. So we know for every buyer there needs to be a seller, and vice versa. When price is pushing up, people were going long expecting a breakout of a resistance level or just continuation to the upside, because we have to remember that at the time of this candle being open, it would have looked like a big green candle that was never going to stop and it's going to the moon. Then the sellers came in and pushed price down. Everyone who went long in this candle are now trapped into a position going the wrong way and are hoping to get out at break even. So let's just say someone entered a position and it looks like this and they're expecting price to break out. Now they're trapped into a position going the wrong way. If price cannot make it back into this area or shows us weakness and gives us a lower high, then that would signal that market maker is keeping these traders who went long trapped and is now getting ready to reverse price to come and grab their stop losses or liquidity levels. If you need an exchange to trade on, consider checking out Bitunix. With Bitunix, it is a no KYC and no VPN, so you should be able to get access to this one worldwide. Using the link down in the description below, you'll get a trading fee rebate on all your trades. Here we have our bullish candlestick patterns, so they are similar to the bearish candlestick pattern, just in reverse. So here with the morning star, we have sellers pushing price down, the next candle opens, no more sellers join the party, the next candle opens, and then the buyers come in and push price up. Same with the bullish railroad track, we have sellers pushing price down before the buyers step in on the next candle and push price up. showing us buying strength. And same with the bullish hammer. Sellers tried to push the price down, the buyers then stepped in to push the price back up, the candle closed, and now we have the bullish hammer. So now I am on the daily time frame, and I just want to show you the same logic applies to a bullish hammer. So here I've just roughly drawn in a support area around 91,800, and in this candle at the time it was open, it looked like a big red candle moving to the downside. There would have been traders who opened short, whether it be here or further down the candle, or there may have even been traders who had sell stop orders at the bottom of this area here, meaning once price breaks that level, it triggers a sell order. They open short position, expecting a breakout to the downside. Regardless, within this candle, we now have traders who went short whilst the candle was open. Then the candle closed back up as a bullish hammer, giving us trapped traders to the downside. From there, price quickly moved to the upside, liquidating or taking out anyone who had stop losses above previous resistance levels. Anyone who had stop losses at 108,460 are still safe so far. Now that you understand the basics of candlesticks, let's talk about time frames and how they affect the way you interpret charts. At the top left corner of my screen, you can see the different time frames. Time frames show price data for specific time periods. If you select the 5-minute chart, this means that each candle is showing you 5 minutes worth of price action. If you select the 1-hour chart, then each candle is showing you 1 hour's worth of price action. If you are a day trader or scalper, then the time frames you will more than likely use are between the 1 and 15-minute charts. If you are looking at the 4-hour or daily charts, then you are more than likely a swing trader. And if you are a long-term investor, then you would be paying attention to the weekly and monthly charts. Timeframes set the stage, but recognizing trends within those timeframes is where the magic really happens. Let's explore how to spot and use trends effectively. There are 3 types of market structures: uptrend, downtrend, and sideways. Each market structure type has its own unique set of characteristics. An uptrend is when we have a series of higher highs followed by higher lows. Picture it like this. Imagine you are climbing a staircase. Every time you take a step, you move higher, creating a higher high. You then pause to take a rest, and when you pause, you do not move all the way back to the last step, therefore creating a higher low. You then take another step, moving higher than you were and higher than the last step, creating a higher high. Again, you take a rest, but when you rest, you don't move as low as the last step, creating yet another higher low. When you see higher highs and higher lows, just like the staircase analogy, it shows that we are in an uptrend. The W formation you see at the bottom of this downtrend is an early sign that price may be getting ready to reverse. What we would want is for price to push above the last lower high, create this higher high, and then when it comes back to retest or create the higher low, this is when we have a confirmed change in market structure. So we've come from a downtrend, we've got our reversal signal, but it needs to be confirmed. The higher low is the confirmation that trend is now changed and we are in that uptrend. A downtrend is the opposite. It's a series of lower lows followed by lower highs. Again, using the staircase analogy, every time you take a step down, you create a lower low. You then take a break or try to step backwards, but do not reach as high as you were previously, creating a lower high. You then take a step down, creating a lower low, because it is lower than you were previously. You then take a break, try to step back, but don't step as high as you were before, creating a lower high. This here gives us a downtrend. The M formation that you find after the uptrend is an early sign or indication that price may be getting ready to reverse. All we need to do is see a change in market structure. So we want to create a lower low below this point here, which was the higher low. Price to then come back and confirm the move by creating a lower high. This is when we would say, okay, the uptrend has ended and we are now reversing into a downtrend. A sideways trend is when price is doing exactly just that, moving sideways, creating equal highs and equal lows. Quite often we can find a sideways trend over the weekend as there is low volume because the market makers aren't on the clock. We can also find sideways trend after price has seen a big rally or drop. Eventually, one of these levels will give way and a direction will be chosen. But why do trends matter? Because trading with the trend increases our chances of success, but it also helps us to identify when the market may just be taking a breather before continuation, or whether the market may be getting ready to reverse and it's time to secure some profit. Trends give us the bigger picture, but support and resistance levels help pinpoint where to enter and exit trade. So let's uncover how to identify these critical levels. Support and resistance zones are key when it comes to determining whether price is likely to reverse. A resistance level is always above the current market price and a support level is always below the current market price. Support is an area where you may see price bounce as buyers may see it as a cheap buying opportunity. Resistance is an area where you may see price reject as buyers may see it as an opportunity to take profit and sellers may see it as an area to open short positions. When drawing support and resistance levels, most retail traders are taught to look left and look for the area where price has bounced many times. This then becomes your area of support. And for resistance, look left, look for the area where price has rejected many times. This then becomes your area of resistance. P.S. That's the all-time high, so that's the only level I can find above price where candles have hit. However, in TTC, we don't use typical retail support resistance levels. Why? Because they are subjective and can vary greatly from trader to trader. This subjectivity can lead to incorrect stop loss placement, making traders vulnerable to being stopped out before the trade goes in their favor. Market makers are aware of where most retail put these levels, and they use this information to trigger stop hunts, collecting stop losses and causing more losses for retail traders. Instead, here in TTC, we use the market makers levels, which are the high of the week, low of the week, low of the day, and high of the day. The high of the week is the highest point price went to in the previous week. The low of the week is the lowest point price went to in the previous week. The high of the day is the highest point in which price went to the previous day, and the low of the day is the lowest point price went to the previous day. The market sessions indicator that you see at the top of my screen helps us to quickly identify where the days of the week are, Monday, Tuesday, Wednesday, Thursday, Friday, plus the weekend. Helps us to quickly identify where the high and low of the week was and where the high and low of the day was. We use these levels because they are not prone to manipulation. The high of the week, I can't put that in any other place. The high of the week is the high of the week. I can't change that. So that becomes our resistance level. The low of the week, same thing. I can't change where the low of the week was. It's not subjective. It has to go in that point. So we use those as our support resistance area. So you can see price has broken through the high of the week. That now comes our support area where we would look for retest for potential continuation in that direction, which is happening at this point in time. However, it is the weekend, so market makers not on the clock. We will come back once the market opens and assess price action then. But if you are in long positions, I'd be moving my stop loss up, you know? So once a resistance level gets broken, it then becomes an area that you would look for as support. And once a support area gets broken, then you would look for that level to use as a resistance. These levels can help you decide where to look for entries and exits, or whether the trade you are currently in has some more gas in it to continue in the direction you are trading. As you've seen, reading crypto charts isn't just about mastering one thing. It's about combining everything we've covered. Candlesticks, time frames, trends, market structure, support and resistance levels. All of these work together to give us the full picture. Learning how to connect these pieces and make informed decisions takes time, but with consistency, it becomes second nature. Remember, trading is a journey and each step builds on the last. If you're ready to dive deeper, consider grabbing yourself a TTC membership where we teach you how to tie all of this into a complete trading strategy using the TBD system.